Hey, what is going on, guys? My name is Nick, and if you're new to the channel, welcome. In this video, I'm going to be sharing some of my best tips and tricks to be able to identify undervalued stocks in the stock market. As an individual investor, it's nearly impossible to beat the market performance over the long term, but there is one proven technique that has been able to do so, and it is used by one of the greatest investors of our time, being Mr. Warren Buffett. And that technique is called value investing, which essentially involves buying businesses at discounted prices to what they're actually worth. Oh, I know, it sounds too good to be true. Just imagine going to the grocery store and finding a freshly cut prime rib that's juicy and everything is great about it, but you soon find that it's $20 per pound. But then you notice the butcher behind the counter turns to you and says, if you come back tomorrow, this piece of meat is going to be going on for 50% off. And obviously you start jumping for joy and get the heck out of there until tomorrow when you can buy it at that discounted price. Well, this is essentially what happens in the stock market all the time. And if you knew exactly when a great business was going to be on sale, of course you would buy into it, but it's all about being able to identify when that business is going to be on sale, or if it is on sale at all. So in this video, I'll be explaining 5 simple steps to be able to identify when a company might be on sale or not, and how to identify tons of companies in the stock market that could be on sale at any given moment. So if you do enjoy this video, make sure to give it a big thumbs up to support my channel and to please the YouTube algorithm to be able to bring this to more investors out there. And of course, if you haven't already, definitely consider subscribing down below for more weekly videos just like this one. And with that said, let's jump right into the video. Now, before I get into the 5 simple steps to identify undervalued stocks in this video, there's one very important thing that you do need to understand. And it might seem obvious, but that is to only invest in businesses and industries that you actually understand. Many investors out there will create a huge position in a company that they might not fully understand fundamentally, and that really poses a problem because you don't know what could happen to that company in the near term or in the long term. If you understand how a company makes their revenues, where the industry is headed in the future, the risks that pose to the business, their competitors, everything like that, then you could probably invest in that business, but otherwise you're taking a huge risk with that lack of knowledge. On top of that, you're also missing out on a competitive advantage that you could otherwise have if you knew more about that business. For example, if you know a ton about video games and you want to invest in Activision stock because you see one of their next games coming out that could be very popular, this would actually give you, the investor, a huge competitive advantage because you know more about that industry than others that might be investing in it. Now, another thing that you do need to understand before getting into this video is that a stock price of a company means essentially nothing. And that means you should not be using the stock price alone to make an investment decision, and I believe this was even quoted by Warren Buffett at some point or another. On top of that, you can't use the stock price to be able to compare one stock to another because it simply doesn't tell you enough information. You really need to dig a little bit deeper into the fundamentals of a company to see if it's undervalued relative to its peers, and we will be getting into that later in this video. And finally, the last thing that I have here is that it's very important to invest in profitable companies and companies that are consistently growing their earnings over time. Otherwise, you'll be risking your capital and essentially taking a bet that the company will be profitable in the long-term future. And it's actually very difficult to determine if the company is undervalued or overvalued if they don't produce earnings. So in this video, I'll only be considering profitable companies for that reason. And with that said, let's get into the first point of this video, and that is to understand the difference between the market value and the intrinsic value of a company. Now, if you're a new investor, you might not have realized this, but the stock market will actually overvalue or undervalue companies over the short term. Now, this is usually a result of very fast and large stock price fluctuations, and it can present really great buying or selling opportunities for the investor. For instance, the market correction that we're seeing here in early 2020 is driven completely by fear, and that is because of a certain sickness that shall remain unnamed is spreading across the globe. And this has resulted in significant stock price hits to both companies that will be negatively affected fundamentally by this sickness, but it's also affected the stock prices of companies that might not be fundamentally affected or might even benefit from the sickness, like 3M that's actually selling tons more face masks than usual. So even though the fundamentals of some companies might remain completely unchanged or even increase in that period, the market correction has dropped their stock prices and actually revealed a great buying opportunity. But over the long term, it is expected that stock prices revert to the mean or the intrinsic value of that company, and this is how insane gains are made as a value investor. So if you can determine the intrinsic value of a company, this will allow you to take advantage of these excellent deals when the current market value of a company is below the actual intrinsic value of a company. However, you don't have to calculate the intrinsic value of a company because it is based on assumptions and it can be very inaccurate at times. So instead, you can estimate if the intrinsic value of a company is above or below its current market value by looking at a few valuation metrics that I'm going to be talking about in the rest of this video. But on that note, do let me know in the comments down below if you do want me to make a video on how to calculate the intrinsic value of a company. So with that said, let's get into the valuation metrics you're going to need to know to be able to estimate if a company will be undervalued at any given moment. Alright guys, now the second step here is to understand some valuation metrics, and these are essentially just comparison tools to be able to estimate if a company might be trading at its fair value, or if it's overvalued, or if it's undervalued. And there are several valuation metrics that I'm going through because there is no single one valuation metric that's going to tell you the entire story. But the first and most practical valuation metric to use to quickly estimate if a company might be expensive or cheap is the price to earnings ratio, or the PE ratio. The PE ratio is a great metric to tell you how expensive a company might be relative to its earnings that it's producing every single year. And to calculate the PE ratio, you can divide the stock price by the earnings per share over the past 12 months, and this is actually called the trailing PE ratio. Now, although the S&P 500 has typically had a PE ratio around 15 to 20, it's very industry specific, so you really have to look at the industry to narrow down on a single company. For example, the technology industry has an average PE ratio of about 30, but then for the banking industry, it might be around 10. So when valuing a company, it's very important to look at that company's PE ratio and then actually compare it to the industry's PE ratio and see if it's lower or higher, and if it's lower, then it might be undervalued. Now there's also the forward PE ratio, and that's actually based on the earnings per share over the next 12 months. So whenever you find that the forward PE ratio is going to be lower than the trailing PE ratio, it typically signals that the earnings are going to be increasing over the next year, and it could be a buy. Now the second valuation metric that we want to look at today is the price to earnings growth ratio, or the PEG ratio. Now this one actually takes into account the growth rate of the earnings of that company, so you divide the PE ratio by the growth rate of those earnings, and that's how you get the ratio. And oddly enough, this ratio does work across many different industries because it does take into account the growth rate of the earnings, and typically it's signaling a very good value if the price to earnings growth ratio is sitting around 1. And the lower that your price to earnings growth ratio goes, the better it is because it shows that the company's growing its earnings very quickly, but it's not priced at a very high price. But of course, there's always another valuation metric to look at, and this one is called the price to book ratio, or the P to B ratio. Now the price to book ratio is calculated by taking the company's price per share and dividing it by the book value per share. And the book value of a company is essentially just the assets minus the liabilities, so essentially the equity within the company. Now again, like the PE ratio, the price to book ratio is very subjective according to the industry that you're looking at. The price to book ratio should really only be used for companies with a lot of tangible assets, like oil and gas companies having a ton of equipment and machinery, and not for companies with a lot of intangible assets like technology companies with a lot of software and everything else. So this ratio could also be used for companies that are in industries like finance, in insurance, in transportation by rail or trucking, etc. And usually whenever a price to book ratio is sitting below 1.5, it's signaling a pretty good buy. So the way that I use all of these three valuation metrics that I just talked about, I first of all look at the value for the company. Does it look respectable? And then I compare it to the industry average. If it's below the industry average, it could be a good buy. And then I also compare it to the 5-year average of that company. And if it is below historical levels, then it could be a good buy. And one site that you can use to get a lot of this data is Morningstar. They'll actually provide a history of all of the PE ratios, the P to B ratios, and the PEG ratios. So I find it's really helpful. Alright guys, so as I talked about, the valuation metrics are a great way to estimate if a company could be undervalued relative to its peers or its past. However, there is one other thing that we need to look at, and that is the balance sheet. Sometimes you'll find companies that are extremely cheap in terms of its valuation metrics, but there's usually a reason for that, and that's because something else is going wrong in the company and something doesn't line up. So in order to support the cheap valuation metrics that we find in a company, we need to use the balance sheet. And there's actually another ratio that we can calculate from a company's balance sheet, and that is called the debt to equity ratio. Now this ratio helps the investor to identify how a company chooses to finance its assets. And usually we want to see a company that has more equity financing than debt financing, because debt has an interest rate associated with it, whereas the shareholder's capital does not. So of course, a lower debt to equity ratio means that the company is using less debt compared to its equity for financing its assets, and that's usually a good sign. And in terms of a specific number, a debt to equity ratio between 1 and 1.5 is usually really good. Alright, now the second ratio that we can calculate from the balance sheet is the current assets to current liabilities ratio, which is also called the current ratio or the working capital ratio. I know it's just insane with all of these different names, but it essentially measures the company's ability to pay off short-term debt obligations. With many more current assets than current liabilities, it shows that the company has equity and that it's able to handle all of the debt obligations within the company. So therefore, with a current ratio greater than 1, you know that the company is going to have a lot more assets than liabilities, and that's usually a good sign. And of course, the higher the ratio, the better, and the safer the company probably is in terms of its balance sheet. Alright, now the third measure that we can calculate from a company's balance sheet is the return on equity. Now this ratio just talks about the effectiveness of the management in deploying their capital and earning the shareholders a return. And the return on equity is calculated by dividing the net income by the shareholders' equity for any given year. And typically a company is very effective in managing their capital and deploying their capital to earn a return if they do have an ROE value greater than 10%. So if we take a look at Apple, the biggest company in the stock market, we find that Tim Cook is extremely good at deploying the capital because Apple did have an ROE value in 2019 of 55%. So clearly a company like that is able to put the shareholders' equity to really good use every single year. And that is one of the major reasons why Apple has grown so much over the past year, because the management is so effective in growing that capital and deploying it into better investments. But on the other hand, we find something that's more normal when we look at Royal Bank of Canada, and their ROE for 2019 was actually 16%, which is still pretty good, but nothing like what Apple can do. Alright guys, so up until this point, I really haven't mentioned the word dividend whatsoever, but it is very important for companies that do pay dividends and to find out if they might be undervalued. And so that's why in step 4, we're going to be applying this one only for dividend paying stocks. Now, of course, in valuing a dividend company, the first thing that I like to look at is the dividend yield. The yield is essentially the percentage of money that you're going to be getting back on your initial investment every single year. So if you put $1,000 in Apple stock and they have a dividend yield of about 2%, you're going to be getting $20 back every single year in terms of cash. Now, I typically look for a dividend yield between 3 and 6% when I'm analyzing a dividend paying company. And the reason for that is that I don't want to buy a dividend paying company that's not paying much at all or less than 3%, but I also don't want to buy a company that's paying way too much in terms of dividends that might not be sustainable over the long term. So the Goldilocks zone is sort of 3 to 6%, and that usually provides some pretty good deals when looking at these next valuation metrics. And this next one is the dividend payout ratio, and what this is essentially telling you how much in terms of earnings the company is paying out for its dividend. And typically the lower the payout ratio, the safer the company is, because it's paying out less of its earnings in terms of dividends, and it can support that dividend over the long term. So what I like to look for is companies that have their dividend payout ratio below 60%, because it still provides a huge buffer for the earnings to drop. Meanwhile, the company can still continue paying that dividend. But as many of you guys have mentioned in my videos, it's also very important to look at the payout ratio in terms of the free cash flow that the company makes annually. So the free cash flow is the amount of cash that a business has left over after paying for capital expenditures that are not accounted for in the earnings. So if a company's payout ratio is showing that it's less than 60%, but the company's actually spending a ton of money on capital expenditures on new projects, then it might still not be able to afford that dividend. Therefore, what you can do is calculate the payout ratio in terms of the free cash flow by taking the dividend per share annually divided by the free cash flow per share, and that will give you the more accurate ratio that you should be considering. And the third thing to look at for a dividend paying company is the dividend growth and the length of time that that company has been paying the dividend. So when considering a dividend paying company, I like to choose a company that's been paying and increasing their dividends every single year for the past 10 years. Usually this signals that the management is very committed to maintaining that dividend over the long term and that they continue planning on increasing it over the long-term future. And this does play a big part in determining a company's valuation. So if a company has been paying the dividend for over 25 years or something like that, it's going to be trading at a premium to a company that's been paying their dividend for only 5 years. So that is something very important to consider when analyzing a company's valuation metrics and comparing it to others in the industry. Alright guys, so we're finally on step number 5 here after talking about the difference between the market value and the intrinsic value of a company, after going through the valuation metrics, after talking about the balance sheet of a company, after talking about the dividend, and that leads us here to how we can find a lot of companies that might be undervalued. And one of the best ways that you can look for companies with specific criteria in mind is to use a stock screener. A stock screener allows you to filter through many different companies depending on certain criteria that you give it, like the price to earnings ratio, the price to book ratio, the price to earnings growth ratio, whatever exchange you want it to be on, whatever country of origin you want the company to be from, etc. And best of all, Yahoo Finance has their own stock screener that I will be linking to down below in the description, and you can use it completely for free. So going through a quick example here, if I want to filter for a stock that might be undervalued at the moment, I want to look at some of the valuation metrics that I just talked about earlier in this video. So what we can do here in Yahoo Finance is actually delete some of the default filters that they have, like the exchange. It doesn't really matter. I just want to pick a stock that might be in the US or in Canada. And then if we click on add another filter, we want to add the price to earnings growth ratio, the PEG ratio. We also want to add the price to earnings ratio, or the PE ratio. We also want to add the price to book ratio, the return on equity, and then finally the 1 year % change in EPS, which will allow us to filter for companies that are actually profitable and growing their earnings every single year. So we want to filter for companies with price to earnings growth ratios around 1, so less than 1 and between 1 and 2. We also want to filter based on a price to earnings ratio less than 20, because that typically signals some pretty good value. We also want to filter based on the price to book value less than 1.5, as I mentioned previously. We also want to go through the return on equity being greater than 10% per year, and then finally having the EPS grow more than 3% in a given year, and that will filter for profitable companies. And then if we scroll down below, we actually find a list of over 400 companies that does match a lot of this criteria. And some companies that do match all of this criteria are Berkshire Hathaway, Bank of America Corporation, Toyota, Bank of China. We also have a lot of oil and gas companies. We have TD from Canada. I think it's on the US exchange, which is why it showed up. And then we also have the Travelers Company. So by using a stock screener, it allows you to do that initial screen for a company that could have potential to be undervalued at the moment. But it is important to continue digging deeper into that company's fundamentals and really understanding what they're about. Because at face value, the company might seem extremely undervalued, but it's very important to look into the industry trends, into the company's management, and all of these other details that can't really be quantified. So it's very important to do your research and continue researching the companies. And thank you guys so much for watching the video. I really do appreciate it. If you did make it until this point, make sure to smash that like button for me. And then also comment down below and let me know if you are buying some undervalued stocks at the moment and if they do match the criteria that I talked about. But anyways, if you haven't subscribed already, definitely consider doing so for more weekly videos on personal finance, business, and investing in the near future. And I will see you guys in the next one.